Hello, everyone. Welcome to our third quarter market review. And it was a great quarter and leading up to a great year so far. I think a lot of that is because there was a recession that really never came. And the Fed seemingly has been able to engineer a soft landing. I know we looked at that in a chart, a past chart of the quarter, looking at inflation coming down, looking at the labor markets. And of course, now the Fed just cut rates over the quarter by 50 basis points uh, and have started that cutting regime. So the markets like that, if you look across at the equity markets and fixed income markets, both experienced really strong third quarter performance. Looking at U.S. equities up over 6%, 6.2%. Utility stocks led the way. And they were the best performing sector year to date. And large cap value actually outperformed large growth by over 600 basis points. So it was great to see a little evening out in the stock market. Of course, large growth has been a leader for some time now. We've talked a lot about the Magnificent Seven and the concentration that we've seen there. So that was great to see that balancing out a little bit over the third quarter in the U.S. equity markets. International stocks performed very well, up over 8%, 8.1%. And what we saw there, that's the developed markets represented by the ACWI. But if you look at emerging markets, those markets were up even more. And I think there's a little more sensitivity to interest rates there. So certainly with interest rates coming down, those reacted a lot more positively. So for those folks that have international strategies where they are potentially using an ACWI ex-US benchmark that includes emerging markets, those strategies with some good EM exposure are going to get a nice little pop from that over the quarter. So in the equity markets, year to date, U.S. equities up over 20% year to date. And in the international equity markets, up over 14%. So some really strong performance over 2024 so far, going into the fourth quarter of the year as we end out the year here. So I think we're going to see some really good numbers here as we close out. Certainly, there's an election coming up. There's some things in the mix as we go into the fourth quarter. But with the Fed starting to lower rates now, I think that is going to be a tailwind. Looking at the fixed income markets, I already mentioned the 50 basis point rate cut that we saw over the quarter by the Fed. That certainly helped the fixed income markets over the quarter. You saw fixed income return of 5.2%. That was the ag return. So a very nice return as rates come down. Total return goes up. That erased really the negative return so far that we had seen with a lot of interest rate volatility over the beginning of the year. In terms of investors, we're sort of rates, not sure where rates were really headed. Certainly at the long end. At the short end, of course, now they're coming down, but now for year to date with the great quarter that we had, up 4.4%. And last but not least, again, another one of the metrics I mentioned this that the Fed looks at, which goes into their calculus with regards to rates, is the unemployment rate, and that remained flat. It's steady at a very attractive 4.1%. So let's go look at some of the specific market segments. And I already mentioned a little bit about U.S. equity and some of the balancing out that we saw in the U.S. equity space, with value really outperforming growth, large value outperforming large growth by a pretty big number. Really what we saw was the Russell 2000 was the best performing for the quarter, though, even outperforming large value at 10.2%. So we saw small value outperform over the quarter. I mentioned utilities were the best performing as a sector, up over 18%, so that was pretty attractive. Growth, though, still they've been leading for a while. This one quarter really doesn't make, a trend. And so growth, when you look at the far top right-hand bar chart, growth is really still outperforming value, has been for a little bit now. So that's the U.S. equity markets. Let's turn to the international equity markets very quickly. Also commented on these markets, mentioned emerging markets as the best performing asset class at 8.7%. You'll see that in the top left-hand chart. When we think about international markets versus the U.S. markets or domestic markets, we have that lower chart there that looks at that outperformance or underperformance. And international really has underperformed, or U.S. has outperformed really for a long time, consistently and regularly. There's been some areas where international has outperformed, but really U.S. stocks have been the leader for some time now. Really, if you go back over the last 10 years. And then if you look at the top right-hand chart, developed versus emerging markets, developed has outperformed for a while, but again, in the rate regime and the high rates, that really hurts emerging markets. Now with the rate regime and lower rates, we may see some more positive performance out of the emerging market category for sure. Certainly there are some issues out there, and certainly China is one, if you're categorizing them in the EM space. All right, turning to fixed income now. Really, the most interesting chart here to look at is the yield curve, and that's the top right-hand chart. And we show the current yield curve, which is orange versus where it was 1 year ago. And rates overall have come down. And that's anywhere from the short to the mid to the long end of the curve. That certainly helps the total return in these sectors. But the curve still is somewhat flat. So this is where, the long end, there hasn't been a lot of movement, but hopefully the curve, begins to correct. I think that's what people are hoping now that the Fed continues to lower short-term rates, those will start to drop below long-term rates. Not sure long-term rates will really move that much. Of course, the Fed doesn't really control that end of the curve. Certainly they have a lot of assets on their balance sheet that can affect those markets. But right now what we're seeing is more of their impact maybe at the short end of the curve. But across the board here, when you look at the different types of fixed income, you can see corporate investment grade bonds were the best performing for the quarter at 5.8%, cash the worst, and mortgage-backed high yield, all the riskier asset segments in fixed income really were the best performing. But across the board, when you look at maturities, everything really did well, and that's represented in that top left-hand chart. Our Kaleidoscope, where are we at for the year? Well, the far right-hand column, large growth, is still the best performing asset class, much like last year it was. So usually these colors change. One of my colleagues calls it the Skittles chart because they're always changing, different years. All of these colors. Interestingly enough, cash has been the worst. I think a lot of people are thinking now, all right, time to deploy money elsewhere, and cash rates are going to be coming down. But interestingly enough, cash is still at a high 4% for the year, as represented by the 3-month T-bill. But really positive returns across the board. Will market leadership change going into the the end of the year? I don't know. It's not unlike an asset class to outperform and be the leader over a couple of different years. We saw large cap growth, in fact, over 2019 and 2020. Keep that position as the best performing asset class 2 years in a row. And of course, again, the Mag 7 comes up. Really, they are responsible for what is happening in that segment. Let's finish it up with our chart of the quarter. Thought this was interesting, and it's really a look back at equity markets and fixed income markets following the first rate cut in a Fed cutting cycle. And it's interesting to see what the markets do after that. On the left-hand side, you'll see the S&P 500. The first cut is denoted by that dotted line. And really the markets, some regimes were up, some were down. And that's really because in some cases the Fed was cutting with a poor market, a market recession, and cutting into a recession. And sometimes those markets continued, the equity markets continued to do poorly. But in other cases, those rate cuts, depending on those conditions, have led to really new bull markets. And that's what you'll see in a couple of those other periods like 95, 84, 89, and most recently 2019. Of course, around the pandemic, there was a lot of not only monetary help in some of these cases, and that's why it's really just not about the Fed, right? In 2019 and around the pandemic era, there was a lot of monetary and fiscal help there that really helped the markets across the board. On the right-hand side, you'll see the 10-year returns or the 10-year for the 10-year Treasury, and that represents the fixed income market. And really, almost in every period, a rate cut helped the fixed income markets. And you'll see that 1984 in a very big way, but it looks like more commonly the markets moved as they did with some of those lower bars, 2001 through 2019. They were up. They were strong, but up and not negative. So some interesting charts looking at some months, 12 to 24 months out, 1 to 2 years out. And a lot now that we're looking at in the fourth quarter as we finish out the year. Markets are going into the end of the year strong, though. Certainly the elections coming up, and potentially at this point, I think a lot of questions now around will the Fed cut rates, and if they do, by how much? Certainly the numbers as we see them today are still pretty strong in the economy, but there's still a few question marks out there, of course, with the election being one of the biggest question marks. And the market doesn't necessarily like uncertainty. Actually, not necessarily. The market doesn't like uncertainty, so that could increase some of the volatility as we go into the fourth quarter. So until then, we'll see everyone next time for the next market review. Thank you.